Welcome everybody. Thank you for joining in. This is a very special session that we are having here today. And it can't be better when we are talking about a topic which is very close to every human being. Yes, we are talking about something related to healthcare. And who better than having a fund manager from asset management company called Bandhan Asset Management. We have with us Mr. Viraj Kulkarni, who comes in with a lot of experience, which is diversified across different companies. Of course, he's been with Bandhan Asset Management for 10 plus years. He's been associated with Franklin Asset Management, Citibank and Goldman Sachs. He being a BTech from University of Mumbai and of course MBA Finance from SP Jain Institute and of course CFA, Chartered Financial Analyst. He brings in a lot of experience, academic side caliber and knowledge of this field, which we are going to try and pick some pointers, some drops from his knowledge base. So today we are going to discuss about healthcare. And healthcare is one space, Viraji, which is spread over various different angles. Let me just put it this way, that it's moving from cure to prevention, biotech, maybe AI coming into picture, insurance growing at a faster rate, and of course expenses possibly may go up, which brings in the opportunity to invest in this space. And of course, US tariffs bring in a new idea. So we'll touch upon as many topics as possible. So let me start with one basic part. Earlier we knew one simple concept called healthcare was divided into three: hospitals, pharmaceuticals, and R&D. Now we hear different terminologies: CRDMO, CDMO. So can you just help us understand technicalities of it?
Sure. So thanks for having me over here. So if I just look at the healthcare space in India, over the last 10 years, it has evolved, as you are rightly pointing out. So if I at least look at the listed space, because that is what we track very closely. 10 years ago, 65 to 70% of the BSE healthcare index or the listed companies were dominated by the export generic segment. So these are the larger companies today. The bulk of their business was exporting to the US, and most of these were generics and not branded drugs to that extent. From there, we have evolved quite a bit to now, where we have, as you said, we have export generics, but that is now only 22% of the index.
Right.
We have domestic brands, which are 35% of the index. We have hospitals, which are another 25-30% of the index. And we have this new CDMO, which is 18-20% of the index. And apart from that, there are a lot of other ancillaries, like there are some IT companies who are focused on providing services to healthcare companies or the big pharma companies. There are medical equipment companies, there are diagnostic players. So it's become a very wide field for investors like us to look at. And each of these sub-segments are very different from one another in terms of the cycles or the capital required or the growth that these exhibit. So that creates very interesting opportunities to pick and choose companies across these various segments of the market to that extent. Now coming to your specific question on CDMO. So CDMO is the newest kid on the block, let me put it that way. So the full form actually is custom research, development and manufacturing outsourcing. So I think that's the full form of it. So essentially, if you think of it in a simplistic manner, the way some big corporations in the US outsource their IT services to companies in India, so that is IT service outsourcing. This is pharma outsourcing to some extent, wherein if a big pharma wants to work on a new molecule, a molecule is nothing but they are looking at a therapy for a particular type of an illness. They can start out by outsourcing the research bit of it to some company either in India or China or Europe or maybe in the US itself. So India is small, China is quite big in this space. So the first step is research, where the company evaluates potential molecules that can cure that particular illness and then selects or shortlists the most apt molecule, at least in theory, because this is all done in a laboratory. It's not done in, there are no trials happening yet. It's a theoretical exercise where you're looking at the kind of illness that is there, you're running simulations, etc., to figure out which molecule is best suited. As you also highlighted, AI can come in, because where there is large amount of data, AI can process this data faster and come up with maybe better and innovative solutions to this problem, because from a universe of hundreds of thousands of molecules, you have to shortlist those 4 or 5 which can be the most suitable for a particular disease or illness to that extent. So that is the first bit of it. Then the second bit is the development part of it, where you develop the drug and the way that drug will be injected or administered. Either it could be a solid where you take a pill, or it could be an injection, or it could be in any other format. Once that development is done, you do limited testing on animals, etc. So this is mainly done by the big pharma, but parts of that is outsourced to companies in India or some other places. Then the next stage is the phase 1, 2, 3 trials. Phase 1 is a smaller trial, phase 2 is a slightly bigger trial, and phase 3 is the big trial where you do it at a large scale as such. And once the drug gets approved, then there is commercialization. And companies or CDMO companies have a role to play in all of the aspects of this entire value chain. So you can get in at the research stage, or you can get in at the development stage, or the phase 1, 2, 3 stage, or you can get in at the commercialization stage where the volumes are quite high. So when we look at companies, we are looking at companies which have different molecules in each phase of these stages as such. So if you are evaluating a CDMO company, ideally it shouldn't be working on only one molecule, because the probability of one molecule succeeding is not very high. You need a company with a big pipeline or a decent enough pipeline of maybe 15, 20, 100 molecules depending on the size of the company, and they should be in different stages of development. Some should be at the commercialization stage where you are already getting big revenues. So that becomes like your cash cow, and you are investing the cash that you generate from that into the first 3 stages, which is researching new molecules, phase 1, phase 2, phase 3, because in those cases you get paid for it for sure, but the volumes are low and you have to work on multiple such molecules. The R&D efforts in this stage are on the higher side, but you need that pipeline for your future successful molecules. That is how your future growth comes from. Your existing molecules will drive a steady set of growth, but for that big growth you need some new molecule coming through every few years to that extent. So that's a very interesting space. It's quite nascent in India. India's market share in the global CDMO market is only 3.5%. China, Europe are anywhere in the 20 to 40% market share, with the rest being the US. So that presents a decent enough opportunity. If you look at the cost, if the cost of doing or manufacturing in the US is 100, in Europe maybe it is 80, in China it is around 40, 50, and India it is 40. So we are 60% cheaper than the US, or half of Europe in terms of manufacturing cost, or the entire cost through the process. So that's a nascent industry. It's not very big, but it provides a good opportunity for growth over the next 5-10 years to that extent.
Interesting. So just taking cue from what you said, new kid on the block and AI. So let me just bring in 3 keywords here. AI being one thing, which is of course getting into even healthcare, pharma, medicine, research and all. And second part is weight loss segment. This is something which is coming up very fast, and I believe India is going to be the next one. And third part, generic medicines. So these 3 things which can be considered as a new kid on the block, whether we have enough opportunities in Indian market to take benefit of.
Okay. AI as of now is quite nascent. So we do not yet know if any company in India will be able to crack it, because AI is working more on the software side of things and not the actual pharma side. So it's a marriage of the software engineers working with the pharmacists to come up with some solution over here. As of now, it's hard to imagine any companies in the listed space that are doing this. Maybe some startup can come up with some very interesting opportunity in the AI space, not just in drug discovery. So yes, there are opportunities in drug discovery, but there are also opportunities in medicine. So if you have a certain illness, instead of going to a doctor, if the AI is able to screen you as the initial screening, wherein you plug in your symptoms into the system, or someone who is not a doctor is able to enter your symptoms into the system, and the AI system will throw up the possible or the most probable illness that you are suffering from. So it's that first check that happens, and then the doctor can do the final check or something like that. So a lot of interesting opportunities are there, and it will require some enterprising startup to come with an innovative solution and crack this market to that extent. So investable universe as of now is limited, but future opportunities definitely possible. The second bit you asked is weight loss. Weight loss is one thing which is already quite big in the US. It's called that GLP-1, which is that entire category of weight loss drugs, and it has become a very, very big market in the US. But the US market is under patent, and I think the patent doesn't expire for the next 4 or 5 years. So the two big boys, which is the Novo Nordisk and Eli Lilly, are largely controlling that market. But other global markets are opening up as and when the patent expiry happens. Even in India, you already have drugs launched by these innovators, and many Indian companies are working on launching their own weight loss drugs over here, and it benefits the entire value chain. It's not just that the drug company benefits, because someone has to manufacture the API, someone has to manufacture the intermediate, someone has to manufacture. Most of it is injectable, so you need a fill finish capacity. Fill finish capacity is nothing but which takes the liquid and fills it in the pen which you inject. You need those pens. There is a shortage of pens, there is a shortage of fill finish capacity. So it's a global issue, not just an India specific issue. So it is throwing up very interesting opportunities in the space. And finally, as the uptake of these drugs picks up, it will also benefit the drug manufacturers, it will benefit the pharmacies which are selling these drugs, and there could be very many other effects of this as well, because in the US at least people have started talking about it. What does this drug do? Let me first come to that. When you take the injection, I think it's once a week or something like that, you don't get hungry. Essentially your food intake comes down. And as your food intake comes down, you lose weight over a period of few months. But the thing is that this is somewhat permanent in nature. So you have to keep taking it to maintain that level of weight. That is in theory. In practice, people are using it to, in the next 6 months, I'll lose say 10 kg. Then people stop. If they don't put on, then they are okay. If they put on again, then they will then they'll again start. But it is having impact on other segments of the market as well, because if lot of people start taking this, then the demand for fast food etc. comes down. The demand for apparel goes up because you have to buy new clothes. The old ones don't fit you anymore to that extent. The demand for testing also goes up in terms of all the pathology labs as such, because when you are administered the drug, it's essential to keep getting tested from time to time. So the demand for that also can go up. So there are a lot of ancillary effects also that this can have if this becomes big. So in India, we'll have to wait and watch if it picks up. We have a decent size of population that is obese, and we have a decent size of diabetics also in the country, and this drug is ideally suited for the obese and the diabetics to that extent. So we'll have to wait and watch how it evolves, but as of now it seems quite exciting as such.
And the generic?
Generic beat. So generic beat is the traditional bit that we have been doing, because in the US or to other developed markets, we have these lot of Indian companies who supply generics. There is a worry on the tariffs front. So let me cover that also, since we are covering the generic bit. At least globally, there is a worry that some of these drugs can get tariffed by the US, because currently the worry is largely with the US, and that's the big worry in the market. In my view, the chance of this happening is quite low. It can happen. There is nothing where the probability is zero. But if you think of it, these drugs, generics, are 80% by volume in the US. So if the US average person consumes 100 drugs in his lifetime or 100 medicines in his lifetime, 80 of them are generics and only 20 of them are the innovator or patented drugs to that extent. But by value, they are only 8%. So 80% by volume, but 8% by value. They are that cheap. Let me just add on what is a generic. So typically what happens in the US is that innovator researches a new therapy and launches a drug. So he gets a patent typically for 10 years where he is the sole seller for that drug. So since he is the sole seller and he has put a lot of money in R&D, he has to recover that R&D cost, and he sells it at a high price to recover the cost. Once the patent expires, a lot of these generic companies file with the FDA to launch similar products. Because the patent is open, so everyone knows what the formula is, etc., etc. You launch a similar product, and as and when FDA approves these drugs, they will get launched as generics. So there is no brand, there is just the molecule that is there, and it will be sold through the US pharmacy chains, etc. But typically when a generic, lot of or multiple generics get introduced in the market, the cost of the drug crashes 90%. So that is the delta. So that is why 80% by volume, but 8% by value. And India supplies 50% of these drugs. And if you look at the US, population is aging, debt is high, fiscal deficit is high, and healthcare is largely free. Either the government provides it or it's provided by the insurance, either Medicaid, Medicare, Medicaid, or the private insurers insure all your treatments as such. So it's in their interest to keep the cost of medicines low. If you put tariffs on these drugs, the cost of it is not borne by the consumer but by the insurance provider, which is largely the government. And the government is facing fiscal deficit, debt, and so many other challenges. So if I add all these things up, the chances of tariffs coming on generics is very low. And till date, even in all of the things that they have done, they have never said that we will tariff generics. In fact, in all the tariffs that have come on pharma, they have always excluded generics from that line item, because generics are also very low value added product, because the cost, if it is 90% lower than an innovator, the value added there is very low. The cost of manufacturing in India is cheaper. So if you shift it from India to the US, the companies will not make any money, because in India at our cost we are making 15% margin. If you shift it to the US at their cost, there is no way you can make money, even with tariffs. Say 25% tariffs come, then also it will be very difficult for you to make money. So the risk of tariffs coming and that supply chain shifting to the US is very low. What will or can shift to the US if they really want it is the high value innovator drugs, where anyways Europe and China are leaders, which is that CDMO space. So as of now, China and Europe are leaders in the CDMO space, where they are supplying these finished products to the US to that extent. If tariffs come on it, it's a slight negative for CDMO companies, but it's also an opportunity for us, because the existing supply chains are getting disrupted. What was getting supplied from China, US will manufacture it in-house, but they will not be able to manufacture it in-house end-to-end from day one. So there is an API, then there is a formulation, then there is packaging, etc., etc. So some parts of it we can potentially get. There is no guarantee, but we can potentially get, and that is where that entire China plus one plays through. So tariffs are a very low risk for generics, somewhat of a risk for CDMO, but in the entire supply chain disruption, there is a chance that we can capture that opportunity as such.
Now, shifting gears and moving to the demographic side of it, especially in the context of India and medicals. Now, Indian side, aging population is gradually increasing, and by 2050, we expect to touch 38 plus as the average age. Second, the overall expense on the healthcare in India by Indians is much lesser, or rather less than $100, while in case of US and all, or the development country, it's multifold higher than in India. Third, the medical tourism or healthcare tourism is something which brings in a lot of people to India or Indian context. So these present some kind of opportunity for the investors to explore, and of course, who better than you to find out opportunities. So throw some light on this.
Yeah, sure. So I think that's a very interesting line of thought, because currently we are at some sort of an inflection point. You would have read, or most of us would have read news flashes wherein they say that our fertility rate has dropped below that 2.1 replacement level. So what it means is that every couple is having lesser than few children. So you're not replacing yourself essentially, which means that the share of young in the overall population will keep falling, and the share of 40, 50, 60 plus year olds in the population will keep growing. Population will definitely grow for the next few years, because we'll keep living longer, because obviously as we are progressing as a society, our average life expectancy is only increasing, so we'll live longer, but the share of 60 plus and 50 plus in the population will go up significantly. Our median age, which is 28 currently, will go to 38 by 2050. So that is the shift that is happening. And when such a shift happens, the focus obviously shifts, or the share of spends in the overall pie will shift from kids and education to managing illnesses, elderly care, wellness, etc., etc. That is coupled with the wealth effect, increasing insurance penetration, which means that we'll demand better quality care, better quality hospitals, better quality treatments, and all of that. To see how this has worked out globally, we also looked at the US as a case study. In 1970, US median age was 27. We are 28 today, they were 27. In 2015, they peaked at somewhere close to 37. Today, they are 38. So, for the last 10 years, it's been largely flattish. So, it's a similar shift, 27 to 37. In that period of time, the healthcare spends as a percent of GDP in the US went from 9 to 21, which means that healthcare sector doubled versus the GDP thing. So, I think the numbers are like GDP went up some X and healthcare sector went up 2X. And in the same time frame, even the MSCI US Healthcare Index gave 2X the returns as the S&P 500. So that's a case study we have from the US, which can get replicated in India. As we age, healthcare spending will grow faster than nominal GDP. And if healthcare spending grows faster than nominal GDP, the profits of the companies in this space will, by definition, grow faster than the Nifty or the BSE 500. And the returns here can be higher. So just connecting the demographics to the investment case that we have over here as such.
Interesting. So coming to the valuation side of the pharma or the healthcare space, this is one part. Since COVID came in, everybody said pharma segment is the darling of the market, or at least the investment word. Then there was a slowdown. Then there were a few more cycles or trends or news which were floating. What is the opportunity today? And especially coming from one more angle which you touched upon briefly, was about the patent side of it, patent getting free.
Correct.
So is there any window which is there where a few patents are opening up and then,
So valuations are expensive. There is no denying the fact. So again, when we are looking at this fund, we are not looking at it saying that valuations are cheap and it's a tactical opportunity to invest. If you look at the average PE of the BSE Healthcare Index for the last 10 years, it has been 35, 36 ballpark. Today we are at 39.40. So we are at 10% premium to 10-year average. This is obviously trailing PE. If you look at Nifty is at a 10% premium to its historical average. And if you look at the mid and small cap space, they are at a 30 to 40% premium to their historical averages. So yes, valuations aren't cheap, but they are not excessively expensive wherein you say it is so frothy that there is no way you will make money from here. And within these expensive valuations, we are having these interesting opportunities in terms of the demographic shift that is happening, not just in India but globally. There are interesting opportunities like GLP-1 which are coming up, and the patent expiry that you highlighted. There is a big wall or a big series of big patents that will expire in 26-27. So that also presents good opportunity on the generic side, because a lot of these generic companies can go and file in the US for their generic drugs, because you have to wait for that period where a lot of patents expire. So when a lot of patents expire, a lot of drugs can be filed and you can start supplying to that extent. So there are multiple tailwinds. One other way I look at it, this sector, is that during a downturn, typically healthcare tends to outperform the broader market. It's known as a defensive. And just to understand why that happens, because let's not go with what has happened in history, but just to look at the practical aspects of it. In a downturn, one, there is liquidity-led selling where people just want to get out of equity and everything falls. But there is another level of panic in a downturn, that if there is a recession or if there is an economic slowdown that will follow a downturn, you are not sure of the EPS or the earnings of many of the companies in various sectors, because demand for products can collapse, banks can have pickup in NPAs, auto demand can collapse. So there are worries around these things. Healthcare is considered to be a defensive because it's a non-discretionary product. If you are ill, you will have to have a medicine. If you have to have a surgery, you have to go to the hospital and get it done.
Recession does not affect.
Exactly. So maybe there will be some impact on the earnings, but the impact will be very muted to that extent. So that is why it's considered defensive. So even if someone is worried that the markets are frothy. Healthcare as a space is not in a bubble territory. It's not cheap. It's marginally above historical valuations, but it also protects in a downside. So it's a good time to look at that space, even if we are worried about the markets going forward as such.
So when we talk about your fund, which is Healthcare Fund from Bandhan Asset Management, how do you plan to construct the portfolio? Whether there are different strategies and approaches better known to you, but still what we hear is top down, bottom up, quality, momentum, growth.
Correct.
So going by that, what's going to be your approach? How would you construct?
So I think first let's look at the top down basis. I think we have identified these 4 sub segments, or we have split the index into 4 sub segments, which is CDMO, generics, domestic branded formulations, and hospitals. Right. Hospitals includes diagnostics also in that. So if you look at these 4 spaces, each has a right to win or a right to grow for the foreseeable 5, 10, 15 years as such. The drivers are very different, but in their own sense, they can grow at a very healthy rate for the foreseeable future. Right. So the idea is to have a very balanced portfolio wherein we allocate 20 to 30% to each of these 4 sub-segments or theme, if you call it, because we do not want to run a very aggressive fund wherein we say we'll have 0 hospitals because the valuations are expensive, or we'll have 50% CDMO because we think the growth is very high. So we'll not be going to any of these extremes. At any point in time, we'll have 20 to 30% in each of these segments. Maybe if we tactically feel something may not perform well over the next year or year and a half, we'll be at 20%. And if we are very aggressive on it, we'll be at 30%. But the idea is to have that balance, because you never know anything with 100% certainty. And over a 5-7 year period, we are confident of all these segments doing reasonably well. So first is on a top-down basis, have a balanced approach. On a bottom-up basis, each of these sub-segments is very different. Also, we have segment-specific stock selection criteria. So you have the traditional valuation, management quality, ROE, which is applicable to all companies, not just in this sector, but any company that you invest in. But beyond that, so if you take hospitals as an example, hospital is a very real estate heavy business. So the supply demand dynamics in the micro market, the hospitals matter a lot. So that will be one of our criteria. So if there is a company which has a bulk of its hospitals, say for example New Delhi or Gurgaon, and if there are a lot of other hospitals or beds coming up near it, then we'll be careful, cautious, and we'll evaluate whether to invest in it right now or wait for those hospitals to come in and see how the impact is to that extent. Another metric could be to see the quality of the medical procedures that they do. If they are doing very high-end work, or if they have a brand, or if they have a star doctor which is able to attract patients, then obviously the quality of revenue or quality of franchise is far better. So that's another tick mark. So we'll marry these things with the valuation, of course, at the end of the day, and then figure out which have the best growth opportunity, because hospitals need to expand. It's a real estate business. You have to keep adding beds. You have to open brownfield as well as greenfield hospitals to that extent. So anyone with a good pipeline, good brand, and its current micro market not getting disrupted because of supply demand will be our selection criteria. So similarly, we will have a separate selection criteria for CDMO, for domestic brands, for generics. I'll not go through the details now in the interest of time, but the idea is to construct a strong bottom-up portfolio within each of these 4 sub-segments. So within the CDMO, if we want to be at 20%, we'll come up with the 4, 5, 6 best ideas which we think can constitute to that 20% weight through a separate lens or separate filter for that CDMO space as such.
So just trying to understand mathematically, larger companies in this space, which may be trading at a higher PE,
correct,
they are consistent in nature.
Correct.
How do you see value in that? Mathematically, if we could just try to...
I think it's the other way around. Some of the larger companies in today's markets are actually available at valuations which are quite reasonable. So if you take the large caps in the listed pharma space as such, the valuation for these companies would be anywhere between 20 to 25 times on a 12 or 24 month forward basis as such. So it is not exorbitantly expensive, or some of these might be actually at trading at their historical average multiples. Some of the higher valuations could potentially be in the mid and small cap space, which is dominated by hospitals and CDMO. So we are cognizant of that. There the growth opportunity seems to be higher for the next 5-7 years, which the market has appreciated and given these stocks those higher multiples. So we are very valuation conscious. If we are investing in an expensive stock, we have to be very confident that it can deliver a 20% plus growth with reasonable ROEs for the next 5-7 years for us to take exposure to that stock. If we have a stock which is at 50-60 PE but the growth is 12-13%, we'll typically avoid that stock. So very valuation conscious, but not to the extent where we just don't look at any company because it's 50 PE. If it's 50 PE and the fundamentals are justifying that multiple, we are okay with it. If the fundamentals are not, then we'll not obviously look at it as such.
So would it be fair to say like healthcare is needed for everybody? Bandhan Healthcare Fund is also needed in everybody's portfolio?
Yeah, hopefully that would be the case. Idea is that we are not running it as a tactical fund.
Right.
So we are not saying that it's a sectoral fund, the time is right, you come in and you will make good money over the 1-2 years. Obviously hopefully markets or the sector will do well over the next 1 or 2 years, but the idea is to position this fund as a medium to long term alternative for people, wherein they get to ride this entire journey of India's demographic shift through a Bandhan Healthcare Fund as such. And we'll manage the fund in a very balanced fashion. We'll not take excessive risk on either side, either be too defensive or too aggressive, or go all in one sector and avoid some sector altogether. Balanced portfolio with risk reward is the way we would like to go ahead as such.
So appreciate Mr. Kulkarni. Really thank you for sparing time and sharing your greater insights. Friends, I must tell you, we look at one word called healthcare, but the way it has been demystified and broken into different components, whether it is GLP-1, whether it is about patent getting freed, whether it is about various generic pharma related opportunities coming up, and many other. Of course, better things are known to the professionals like Mr. Viraj Kulkarni and fund managers. So it's better that we look at this opportunity as on the healthcare space, just like it is needed for every individual. Let's have Bandhan Healthcare Fund in every client's portfolio, because timing is not important. What is more important is we put the right product in the right portfolio of every investor. So with this, we thank Mr. Viraj.
Thank you so much
and,
for having
Bandhan Asset Management. Thank you so much. Truly appreciate it.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.